Hello, everyone. This is Daharsh with Advanta IRA, and I am here to bring you a great educational webinar on investing in spec homes with your retirement account. If you did sign up for this webinar and were expecting Raquel Adkins, unfortunately something came up and she is unable to join us today. But rest assured, I'll still try to give you the best educational content on this topic as I can. I do want to let you know as an audience, you will be muted through the duration of my presentation today, but I do want your active participation. So if you have any questions as I'm going along, I've got a view of the questions box from GoToWebinar on my secondary screen. I'll try to keep an eye on that and answer them as I go. Otherwise, at the end, when I conclude the presentation, I'll also give you a chance to ask any questions. Please find that. It's on the GoToWebinar panel you should have on your screen, and just go to the questions box. You can go ahead and type them in there. But without further ado, I'll go ahead and get started with the presentation. Again, my name is Daharsh. I work with Advanta IRA. I've been with the company since 2016. I have what's called a CISP, or Certified IRA Services Professional designation, that I achieved in 2018 and keep active with continuing education annually. And I've done a number of different roles with the company. I've served in the accounting back office. I've worked as a client account manager for a number of years. And my current role as a business development specialist basically means I conduct a lot of these educational webinars and do educational speaking and presentations in person, a lot of networking and things like that, just to share with the population that these self-directed retirement accounts exist. They're very easy to utilize and to get set up. And it really puts the power in your hands to guide your own retirement dollars where you have interest and see fit, not just being told where your money's going to be placed and having your fingers crossed or knocking on wood that those investments thrive and do well. If you have any specific questions for me you'd like to ask offline, please feel free to take down my direct phone number or reach out to me via email or on any of the social platforms I have linked here. Real quick as well, if you'd like a copy of my slide deck from today, you can go ahead and email me and I'll be happy to send you a PDF version, or the recording of this webinar should be live on Advanta IRA's YouTube page within about 1 business day. And if you signed up or registered in advance and are maybe attending live, you'll receive a copy emailed to you as well within about a business day. So to cover today's agenda, I'm just going to cover the basics of self-directed investing, what these accounts offer, what the rules are surrounding them. Then I'm going to go into what spec home investing is and kind of some considerations to have with spec home investing. I'm going to cover some IRS rules in regards to spec home investing and some feedback from Advanta IRA's side, some things to be mindful of and considerations to have. And then I've got a case study, and then we'll end with the questions and any final questions you have in a conclusion. So Advanta IRA is a self-directed administrator. We've been in business for over 20 years. We've got over about 13,000 clients actively right now, and those clients hold over $3 billion in assets under management. All of our clients' funds that are not actively invested are insured up to FDIC limits. So your money that is not actively in an investment is safe and insured. And all of our clients are paired with a dedicated client account manager. Again, I served in that role for about 5 years during my time with the company. That is really a white glove customer service that we're offering. Each person has a dedicated point of contact, your client account manager, that you reach out to when you have any questions, want to talk about strategies, need anything accomplished with your account. So you don't have to call a large call center and explain who you are and what you're trying to do every single time you're reaching out to conduct some activity with your account. Just a quick disclaimer, I'm here to provide educational content. I am not here to endorse or promote any specific investments or products or opportunities. Everything I'm covering today is strictly for educational purposes, and I always, as does Advanta, implore you to do your own due diligence. So meet with your own team of attorneys, accountants, financial advisors in context of spec home investing. I'll go ahead and add contractors and architects and different aspects that you're going to be dealing with when you're doing a spec home as well. Make sure you're doing thorough due diligence. It's always important to know, like, and trust the people you're working with. It's even more so important when you're taking your tax sheltered retirement dollars into your own hands. So what is a self-directed IRA? This also includes 401ks for that matter. But a self-directed account is really an account where your administrator is not a fiduciary or a financial advisor, and you're ultimately allowed to invest into anything you'd like to with that account. So a few different asset classes that we see very commonly are real estate or lending, private placement or syndication style investing is also pretty popular. But again, this type of account, a self-directed account, is one where you don't have to go to anyone and say, hey, can I do this or can I not do this with my retirement dollars? As long as you're falling within the IRS's rules and regulations, which is what we're here to assure and be experts in, you can invest into pretty much anything under the sun that you have interest in or maybe have an expertise in, and utilize your own retirement dollars to generate larger profits and also tax sheltered profits on some of these investments you may be doing with your personal savings or by borrowing money from other individuals. It's a great strategy and tool, whether you use it to diversify and keep some money in the publicly traded sector like stocks, bonds, mutual funds, or decide to switch full force into a self-directed strategy. There's a number of different types of plans that can be self-directed. Most people are familiar with your traditional and Roth IRAs. They have an annual contribution limit about $7,000 or $8,000 right now. And as long as you're generating earned income, you can add money each year to those account types and continue to build and continue to invest and let the earnings build within the accounts. There's also SEP and simple IRAs and solo 401ks or individual K plans for small business owners with only a few or no W-2 wage earners or employees in that business. And we also offer health savings accounts and education savings accounts. If you have a high deductible health policy, a health savings account's a great tactic and tool to utilize, and an education savings account is a wonderful tool for those young ones in your life that you'd like to invest some money while allowing a tax benefit when you need to take out money from the account for any qualified education expenses. So if you have interest in any of these plan types, or even just want to have a chat with me about what plan type would fit your needs best and what plan types you currently have, I'm always open and happy to help point you in the right direction there. So why do people switch to a self-direct account? These are a few of the key reasons. One being it's a new source of capital for investors that are already doing a certain type of investing. Maybe you're an existing spec home investor and you're here just to check out some educational content, but you didn't know that you could actually do this with your retirement account. That's a really key way that people choose to switch to self-direct, is they find it's a new source of capital. The stock market fatigue, so people that have retirement accounts that are in those publicly traded assets like stocks, bonds, mutual funds, or with a fiduciary or a financial advisor, just not seeing the returns they want to, or are not as happy with the fluctuation, the upturns and downturns of that market. Just getting out of that, whether it's diversifying or full force switching over to self-direction, that's another major reason we see people switching over. And then finally, the tax benefit. So when you're utilizing a retirement account to invest into real estate particularly, the investment is not going to be subject to capital gains tax. All the profits are growing either tax deferred or completely tax free if you're making the investment with a Roth IRA or 401k. So there's a lot of tax benefits that you get there. With real estate, I will be mindful and address you're not able to necessarily partake in some of the depreciation type tax write-offs that you would when you're investing out of pocket, because you're getting these benefits of tax deferrals and other things that are allowed within the retirement account. So again, tax strategy, I can't advise or speak to more than just laying out what the rules and the expectations are. From there, you'd want to speak with your own CPA tax advisor to build your own strategy that fits your needs and your goals. So the rules around self-directed investing are very simple to understand for the most part. The only asset classes you're not allowed to invest into are life insurance policies and hard to value collectibles like antiques, fine wine, artwork, anything that has a subjective value. There are some currencies you cannot invest into, but for the most part, precious metal investing is an allowable investment strategy. So if you're interested in that, that's a separate webinar for a separate day on a different topic, but we do have content on that as well. And the only other way besides those asset classes that the IRS restricts how you use these accounts is by labeling certain individuals as disqualified persons. And what you're not allowed to do is transact with disqualified persons. And I'll cover that in detail in the next few slides. But you can partner with disqualified persons. So that is to say, I can't buy a property from a disqualified person. I can't let a disqualified person do work on a property I'm developing as a spec home, but a disqualified person and I could partner together, our retirement accounts or my retirement account and the disqualified person as an individual, to pool our money and resources to do a deal. The other aspect listed here is UBIT and UDFI taxes. We're not going to get into those today, but I just want to briefly say unrelated business income tax is a tax that becomes applicable when your investment is generating more active income and not necessarily 100% passive income, which is the intention of these retirement accounts, is to generate passive income. So if you start to get to a threshold where you're actually running a spec home investing business through your retirement account, you may be subject to UBIT tax. Again, speak with your tax preparer provider when you start to scale this, if at all applicable for you. And unrelated debt finance income applies if you're utilizing leverage, which I'm not going to cover today, but you are allowed, just for general context and purpose, to borrow money in the name of your retirement account to make investments. So I could borrow, take out a mortgage basically, or borrow a loan from someone or some entity to do investments with my retirement account. The amount or portion of the overall project that is leveraged is going to be subject to UDFI tax unless you have a solo 401k plan, which is exempt from UDFI tax. Again, like I said with precious metals, UBIT and UDFI is a separate topic for a separate webinar, which we definitely have in our educational content. Please feel free to reach out to me if you have any interest in any of that. So breaking down a little bit further, disqualified persons, what the disqualified persons really mean are yourself, your spouse, and your lineal descendants and ascendants. So anyone on the main trunk of your family tree and or any businesses that those individuals own or control day-to-day decisions for are considered disqualified persons or in the disqualified persons category for the purpose of investing. So again, that is to say, with a few examples here, my IRA cannot purchase a piece of real estate from my son. If I own a piece of real estate in my IRA, I can't let my father be the tenant at that property if I'm trying to help my parents get into a stable place as they retire. Those are just some brief examples. I'm not going to read every single one of these. I'm sure you guys can pretty much get the gist from there. If you have any questions, that's what I can either answer for you as you're deciding to move forward with a self-direct account, or your client account manager is always there to answer for you when you're an active client of Advanta IRA. Reiterating again, it's always important to find the right deals and invest with people you know. I would always recommend checking out your local RIA group, your local meetups. Maybe you have a bigger pocket chapter or group organization near you. A lot of these groups have free meetings. You can meet the players in your area that are doing this type of investing, learn from each other, partner on different deals. But again, be very thorough in your due diligence. It's very, very important. So the basics on spec home investing is that a spec home is a shorthand form of speculation. You are going out, doing some research and some due diligence and deciding, I think I'm ready to take the risk of buying this piece of property, developing this property, and then selling the property on the speculation that I'm going to generate a large profit. There's a lot of kind of due diligence that goes into this, involving the location of the property that you're going to develop and the development costs and different associated factors there. So talking about location, you may just find a plot of land right up the street from your neighborhood and think, hey, this is a great place. I love living here. Maybe it'll be a great place to develop, but there's additional considerations you want to take place Like, what is the crime rate potentially in this area? What is the job growth in this area? What are comps for other homes that have sold in this area? If I'm going to spend all this money to buy this piece of land and develop a brand new property on it, you really want to make sure that you kind of look at all of those aspects so that you know when you're ready to sell that property after you've already invested so much of your money into it that you're going to generate a worthwhile profit. And then on the flip side of that, once you've actually purchased the land, the development, you're going to have to work potentially with architects and contractors and various different contractors in that matter. So it's very important to build the team that you want to work with, make sure you're cross-shopping and cross-comparing, general contractors and subcontractors potentially. It depends on how involved you plan to be, but it's very important to build that right team, find the contractors, whether it's the architects, the window guys, the concrete pourers, the roofers, whoever it may be, that you want to work with, that are going to do a great job, charge you a reasonable rate, and let you get out of this deal when you go to sell this spec home with a generous profit. And again, as I mentioned earlier, your retirement account can partner with disqualified persons as long as the investment is made together at the outset. And the ownership percentages are always going to be based directly on the total amount that is brought to the closing table from each party. So let's just say I want to do a real estate deal in a spec home for $400,000 and I bring 100,000. That means I'm going to have 20% stake or 20% ownership in that deal with my retirement account. One quick consideration, when you're doing these types of things, the partner should consider structuring options to ease record keeping, like setting up an LLC and having all the partners invest into an LLC, and then the LLC itself goes out and does the spec home investment, or a joint venture agreement, or a real estate investment trust. Those are all tools that you can utilize to make the record keeping of this deal a little bit easier and make the ownership percentages and all of that a little bit smoother as you go through the project and have to pay expenses throughout the progress and have to split the income generated when the property is sold at the back end. And I'm going to break that down a little bit further. The next few slides are just different aspects or ways that you could spec home invest with a retirement account. So the first one here is 100% IRA owned. That is to say, I've got money in my retirement account, definitely enough to go out and buy a plot of land and then go out and work with contractors to develop that land without having to borrow money, without having to partner with anyone else. This is all being run through my own retirement account. So considerations here, when you're coordinating the work, again, because you're not able to do any sweat equity, you basically serve as a general contractor for the project. You're definitely allowed to choose the vendors at your discretion, go on site and inspect the work and coordinate and approve payments and so forth when the work's done to your satisfaction level, and work with the real estate professionals when you decide to sell the property on the back end. So you can choose whatever listing agent you'd like to work with and your closing attorneys and so forth. But again, you can't do any of the work. If I'm a flooring guy, I can't do the floor on the spec home I'm running through my retirement account. Pretty basic. I know I'm kind of beating some of those aspects home, but they are things that some people look into these strategies and don't necessarily understand, or maybe try to disregard, and that could put you in a very bad situation with regards to the IRS. How will costs be handled? All of the income and expenses need to flow directly through the retirement account. So again, that is to say, when I need to go pay a vendor for services done or pay for materials that were purchased for the spec home, I can't pay out of pocket and be reimbursed at all. I have to run all of that directly through my retirement account. That's another aspect why the LLC or one of those partnership situations I mentioned on that last slide may become valuable. But it's also very easy to do that directly through your retirement account. We have an online portal. You can log in 24/7, submit a request to have us pay a vendor, and we process that payment the same or the next business day that the request and invoice is received. As a self-directed investor, you control all the terms of this type of deal. It's 100% owned by your retirement account. That retirement account is owned by you. You control all of the terms that I've discussed and outlined in this deal. I do see a question come on. Let me go ahead and read this through real quick. I understand that one cannot guarantee debt for one's IRA. However, many non-recourse lenders require that the borrower sign bad boy carve-outs, essentially personal guarantees in the event of fraud, waste, environment conditions, and mismanagement. Given that these are signing guarantees on the event of fraud or example, can an IRA holder sign this type of agreement? I don't know that I want to give a specific seal of approval to sign that type of agreement. Honestly, in my understanding, I would lean towards no, declining to sign that type of agreement. If it's a loophole type deal to get you to sign a personal guarantee because they know that the rule disallows you from signing it, I would say no, I'm not going to put myself in a situation of this loophole that may run afoul of the IRS's rule. Having said that, again, I can't provide any legal advice, so that may be something to speak with an attorney or run by your legal professional before deciding to sign it or not. But just to break that down further, the way the beginning of that question was worded, I think is going to be very helpful to the rest of the audience. The retirement account is seen as a separate entity than you individually. And anytime a loan, like a typical conventional mortgage, is put together, you have to sign a personal guarantee. And your retirement account, being the borrower, is not a human being and not able to sign a personal guarantee. So what this question is asking is, there are loopholes or there are bad boy carve-outs, in quotes, in the question that kind of circumvent the nature of the rule, as that lender is really trying to have you sign a guarantee in the event of fraud, waste, environmental conditions, and mismanagement. Going by the lay of the land, per the IRS rules, you probably shouldn't do that. I again would concede to appropriate legal professional there, but just so everyone understands, your retirement account is not you, so it can't have a personal guarantee signed in any capacity, and that is the nature and requirement for non-recourse lending when you're going to borrow with a retirement account. We, again, as I've referenced earlier, have plenty of educational content on that specific topic and strategy, non-recourse lending. We've got some institutional partners that we could provide you reference to. Again, not endorsing them or promoting them, but if you needed to connect with some non-recourse lenders, we've got a few that we can point you in the direction of to check out. And I believe this may be an extension of that first question. Let's say you're investigating a new market for IRA-related investing. Is it okay to pay for travel to the location with personal funds prior to any investment by an IRA is made? You would have to travel and pay for food, room, etc. Out of pocket. You're not allowed in any capacity to pay those types of expenses with your retirement account. Those are current benefits to you, flying you somewhere, feeding you. Those are not to be paid out of your retirement account unless or until you actually draw a distribution out of the account and basically settle up with the IRS regarding taxes potentially on that money. So not only is it okay, it is required that you pay out of pocket for those types of expenses outlined in that question. All right, I'll get back on track with the second kind of investment scenario for spec investing, and that's going to be a limited partnership. So what value is each partner bringing to the table? When you're doing a limited partnership into a spec investment, your retirement account is ultimately going to be the limited partner. So what that means is, as a limited partner, you're putting up money that go towards the deal, while another team, the general partnership team, which generally also put in money to the deal, but they make the day-to-day decisions on the investment. So prior to even making the investment, they're going to provide you with a prospectus or a private placement memorandum. It's typically going to be a lot of different pages. It's going to tell you what the property is, what the development strategy is going to be, what the exit strategy is going to be. And it's basically your job as an investor to thoroughly review that, make sure you know, like, and trust that general partnership team and expect them to follow through on that plan to the best of their ability, so that they generate the profits that are outlined. But again, all you're doing in this case scenario is putting up your money at the agreed upon rate and subscription agreement with hopes that the deal goes exactly as the plan or better and generates the most profit possible. So how will these profits be split? Each limited partnership investment may have a different profit breakdown, but in almost all cases, the limited partner investors are paid in full before the general partnership gets paid anything. So they have a vested interest in making you your money back plus profits so they can get paid. But the additional profits, when the project goes exceptionally well, may have a unique breakdown, like a waterfall chart. So it's important to read through that breakdown and the private placement paperwork thoroughly. One project may, on the back end, if the project goes very well, have the general partnership team taking a larger chunk of that profit than the limited partnership team. That may be because they're A+ general partners or who knows what, but it's very important to understand that so that you know all aspects of how that deal is supposed to play out. Oh. As a retirement account investor, you do concede control on day-to-day decisions to the general partners when you invest as a limited partner. So again, making sure you have a thorough understanding of what's expected to take place is very important, because there's no point in the middle of the investment that you can jump in and say, hey, I wanted this done this way. You have to switch it now because I want it done and my money's in the deal. That's not how limited partnership investing works. That's why due diligence is very important. And then joint venturing. So joint venturing is kind of the little brother, if you will, to limited partnership investing. It's basically where the partners that comprise of the joint venture bring something to the table and have an agreement on how the profits are going to split by the end of the deal. In this strategy, most of the time, retirement accounts are bringing cash or even the property to the table, and they're partnering with contractors or other cash investors, or maybe the other investor is bringing the property to the table and the retirement account's bringing cash. It's unique how this gets built together because it's always based on what you have to offer as a retirement account. That's going to be cash, and it may be property, but more likely it's cash, and what the partner you're working with has to offer, whatever goods, services, or money that they can add to the deal. The costs and profits in this case scenario are going to be split based on the ownership percentage, as I went over earlier. While the IRA could own 100% of the real estate, the joint venture partner could pay all of the construction costs and conduct the sweat equity. So it's very important that you understand how that's going to be set up ahead of time, and you have a clear expectation of the profit and proceed breakdown when the sale occurs. Maybe I brought 100% of the property to the table. The property had a valuation of $100,000, and then the joint venture partner, by way of construction and sweat equity, put in the equivalent of $150,000 into the deal. We could agree to split it 50-50 because I brought the property to the table. We could agree to split it where he gets a higher share percentage of the profit and proceeds. That's completely up to you. You control all the terms and draft the joint venture agreement with your partner, and that's executed by all parties involved in the deal. So unlike limited partnership investing, this goes back to the case scenario from the first strategy I outlined, where you control everything as the retirement account investor. So I've got a case study here, pretty simple case study, and then we'll pretty much wrap up today's presentation. In this case study, I've got David, who finds a plot of land in his community and decides it would be a great investment given the location and the job growth in the area. He makes an offer to purchase the property for $75,000 and expects the development to cost about $250,000 to build the home he's researched for development purposes. Because this is a cash deal, David's able to close on the property very quickly and begin the construction project through his retirement account. All sweat equity must be done by those third parties, as I've outlined. David connects, coordinates with the contractors, make sure the work's reviewed and paid out of the retirement account directly so that the deal is smooth, simple, and easy for all parties involved. What David does in this case is finds the property, makes the offer to purchase in the name of his retirement account, approves all the closing paperwork so that Advanta IRA is authorized to process the deal and close on the property in the name of David's retirement account. Then David negotiates and hires the contractors, tells us when to pay them and what amounts or what materials were purchased and things like that, and then coordinates when he's ready to sell that property with the real estate agent and brokers at his own discretion. Once David authorizes and approves to the sale terms, we execute that sale closing transaction and make sure that all the profits and proceeds flow back into the retirement account. So that's where the client account manager is going to work with David directly to keep this as smooth as possible. We're also going to work with those contractors and the legal professionals or real estate professionals involved in this transaction so that everything's smooth, simple, and on the right side of the IRS's rules here. So just a brief explanation of an outcome of this type of deal. I really did try to use rounded numbers, but reasonable numbers to that credit as well. So David invested a total of $325,000 into building this property within his community. After the construction's done, he lists the property and sells it for $425,000. All of those profits and proceeds go back into David's account. That is $100,000 of profit generated. That's either going to be tax deferred or tax free, depending on the type of the account, whether it's a traditional or Roth. And there's no capital gains to be paid or other applicable taxes on this cash deal. He can now use that $425,000 towards another spec home. I reference fix and flip real estate, which is very similar to spec home investing. Take everything I've told you today, and instead of buying raw land and developing property, you buy land with a property on it and upgrade it, or demolish it, build another property on it, and you're doing fix and flip investing. While there's no rule, again, I want to reiterate this, I said it earlier, while there's no rule as to how many spec homes or fix and flip deals you're allowed to do within your retirement account in a given year, you should not be using this strategy to run a developing or a selling house business. All retirement investments are intended to generate passive income in nature. If you're getting into a threshold, there's no black and white rule, maybe 5, maybe 7, upwards of a few. In a given year, you're going to want to speak with a legal professional and see if your retirement account is subject to UBIT tax, unrelated business income tax. All right, so that pretty much concludes today's webinar. I just want to make sure I leave you guys with some key takeaway points. I'm sure you've all heard me say these multiple times. Know, like, and trust. Conduct your due diligence thoroughly. You're in the ultimate control with self-directed investing. No sweat equity allowed. Your retirement account's the investor, not yourself as an individual. That means yourself as an individual is a disqualified person from doing anything labor intensive on the deal. Retirement investing should create passive income separate from running your own spec home development business. I'm going to go ahead and flip this back to slide number 1 with my contact information while I give you guys a few moments to add any final questions in here. I did see one additional come up. How would rules regarding owner efforts apply to workout situations where the investment with the joint venture partner did not perform as planned? I would say that's going to go to the joint venture agreement. How would rules regarding owner effort apply to workout situations where the investment with the joint venture partner did not perform as planned? I'd say, again, that's probably going to be something that you want to specifically outline in detail in the joint venture agreement. Have considerations or clauses regarding if the project does not work out or a partner does not fulfill their expectation of duties, and how you're legally going to take action, if at all, or resolve and remedy those situations. It does not in any capacity allow you to conduct your own owner efforts, which would be sweat equity, if the other partner is not holding up their end of the deal. That's why it's very important to have an ironclad joint venture agreement. I'll give about another 60 to 90 seconds for anyone else to add any additional questions, and I will be very happy to help. What does Advanta charge to make payments to contractors? Because this is a recorded webinar that's going to live in perpetuity online, I'm not going to give a specific dollar amount, but you can reach out to me directly, or if you're an existing client, your client account manager, and they can verify that charge. I just know this webinar is going to be up on the internet in 3 years, 5 years, 10 years. Not that we change our rates often at all. We've changed our rates once in the 8 years I've been with the company, but I just don't want to leave a carbon footprint on something like cost. Very reasonable, if at all. A lot of times those things are free of charge. So I can say that, but anything further, reach out to me directly. I'll send you our full fee agreement, or reach out to your client account manager. They can easily answer that question. And that seems like it. Again, if anyone has any final questions that you'd like me to go over for you, please reach out to me directly. I hope you all have a wonderful rest of your day, and we will see you next time. Thank you.